Welcome to the Home Building Hub, your essential podcast guide to building your new home. Hosted by industry experts Colin Bischoff and Darren Brennan, this conversational podcast will help better educate you about all things new home building so you can avoid costly mistakes and enjoy your building experience to the fullest, no matter which home builder you choose.
Hi there, folks. Welcome to the Home Building Hub. My name is Colin, and I'm here with co-host Darren Brennan. We've got a special guest joining us today, and the topics we'll be covering, and we're going to talk all things finance. So this is the second episode that we've recorded, and we wanted to start at the start of the process. So we really wanted to find the right guest to help us do that, and this guest is one of Australia's leading construction mortgage brokers, and they have settled over $1.5 billion of loans, and that is with a B, Darren. So there's a fair bit, of experience in that. And the topics we'll cover loosely today: finance broker versus going direct to bank, construction loans versus established property loans. We're going to talk about investment loans and owner-occupier loans within that. And then we'll touch on probably the bigger topics of interest rates, and we'll get some feedback around buyer confidence, government grants and schemes, and those sorts of topics. Okay, so before we begin, we do want to come in and I guess we have to have a disclaimer. So I will read that out for you now. Whilst we're all about providing value to you, this podcast should not be considered legal or financial advice. It does contain general information only, so it's always best you seek independent professional advice from your personal situation before making any legal or financial decisions. So now we've got that out of the way, I'm going to pass over to you, Daz. How are you going?
Man, I'm great. You?
Yeah, not too bad, thank you. Getting through it. There's a lot happening in our industry.
Thanks for joining us. Mate, it's never dull, which is good. You know, it keeps us all on our toes, I guess. And it's certainly been an interesting period of time the last week or so. So, I'm sure that'll come up as we talk throughout the episode today at some point. But, certainly it's challenging times in the economy and challenging times out there for everybody. So, I guess we're here to try and help guide people along that journey. So, yeah, it's all good. Mark, how are you, mate?
Yeah, very well. For us, as you mentioned, there's a bit of an interesting time. We are pretty active, I suppose, in the market with clients sort of reaching out. I think the engagement is probably the highest it's been in a very long time, purely because of everything that's happening. But to answer your question, we're busy. I think it's going okay. Yeah.
Well, I might give a quick intro for you, mate. Number one, thanks for being our first guest on the podcast, mate. And so we've obviously got Mark Polatkesen from Mortgage Domayne. Mark's got over 20 years experience in the construction loan part of finance, which is amazing. He's one of the leading brokers and runs one of the leading teams with over 15 brokers working under Mark's reign in both Victoria and Queensland. As Colin mentioned earlier, done over $1.5 billion, billion dollars worth of loans. So it's massive, right? Massive. Awarded the best customer service in Australia for 2022 at the Australian Broker Awards, which is a great, mate. That's an awesome award to be getting. And mate, tell us a bit more about you. I guess we'll leave that as the lead in, mate.
Yeah, of course. So I actually joined the industry at the age of 19. Funnily enough, I went to a mortgage broker to get a loan. And then when I got my loan approved, I asked them for a job, and that's how I got into the industry, and I never looked back. So I suppose I've always been passionate about numbers. I've been always very analytical and solution sort of focused as well. So for me, the mortgage broking industry was a perfect fit. Obviously, that's kind of evolved from being a standalone broker from going back when I was 19 to now we've got a full-scale team. You mentioned we've got 15 brokers, but that's not the entire team. We've probably got about 20 people, I suppose, in the back office administrative team as well. I suppose the brokerage is, I suppose, what we call more of a holistic service offering. It's not just the broker. There's different people in the business doing different things, just to make the process of the construction finance much more seamless. the space that we work in, we're typically dealing a lot with first home buyers, and it's quite new to them. So we want to make sure we've got the right people at various stages, giving them, our clients, the right information. So just to expand on, obviously we've got the brokers in the front end. We've got loan administrators and also credit analysts that will basically do the research and make sure we're doing the right recommendation to the clients as well. We've got dedicated people that help with, the dedicated schemes and grants that are currently available, which we'll talk about a little bit later. And then obviously post-settlement, we've also got people in the business that will do things like progress payments as well. So we can handle all the invoices on behalf of the client that are coming from the builder direct. And that's the way that the business is sort of set up.
Yeah, good. And obviously, it's grown a lot over the years, mate. And, I know, obviously we've known each other for, it's got to be coming up towards 15 years, I guess. And just seeing that change and growth, it's been enormous, mate. And hats off to you guys. And, certainly exciting times when that's happening in any business, I guess. Well done.
Thank you. Yeah, it makes it easy when you love what you do and you're passionate about it. So, we like getting people into homes, and, what we like mostly about construction finance is we've got more time to assist clients in terms of working on time frames. So, I suppose compared to an established property where you've got a 30 or 60 day time frame to get the client into a house, home and land, you might have 6 months or 12 months, and the client's situation can change. So we can work more on, I suppose, implementing a strategy to get them into a home.
Yeah, great point. So I guess maybe to kick off with one of the things we'd love to get a bit more info on, I guess what's the difference between using a broker and using a bank directly, rather than, going straight to your bank? What are the advantages that a broker is going to provide?
Of course. So look, we've got access to the same products that the banks are able to offer. But I suppose one of the key differences between a broker and going to the bank direct is actually the variety in options that we're able to present. So, if let's say you're a customer of the Commonwealth Bank, you want to get a home loan, normally that would be your first point of contact. You normally go to the bank that you bank with. But that may not necessarily be the right solution for you. So for a couple of reasons, maybe the policy doesn't suit your requirements, or the rate might not be the most competitive out there in the market. So working with a broker will give you access, in our case, access to 45 different lenders. So we're able to identify, I suppose, what your requirements are, and making sure that we give you a recommendation that's going to suit you in total, not just pigeonhole you to what we think is going to work best. So with that one particular bank. I guess
using your expertise too, you're able to take a lot of the shopping out of it for the customer too, right? That they're not having to go bank to mortgage society to somewhere else, other lending institution, and try and trawl their way through it. You guys, being the experts, can really guide them to the right place, and here's option A, B, and C that'll work for you. And guide them to what might be the best possible option out of all of those.
Yeah, absolutely. I think usually when a customer or client will look at a lender, they tend to typically only look at the rate. There's a lot more to that when we're selecting a lender. So obviously making sure the actual product is suitable. But separate to that is the policy. So, you might have certain circumstances that your particular bank may not cater for, but the next bank will. So, for us, we're very big on, I suppose, recommending policy, because we want to make sure that, it's all well and good to submit an application. We want to make sure that it gets approved. And if you've got, let's say, short-term employment, or you're casual, you're self-employed or whatever, certain banks are better at that than others. So, just making sure that, yes, we obviously try to get you the most competitive rate, but the policy is also important.
Yep. What's the difference between someone like yourself who really specialises in construction finance to a typical broker that would just look after the established houses, those quick turnaround jobs you're talking about earlier? What's the big difference there, and what's the expertise that you guys bring to the table there?
Yeah, look, I think for us is the amount of exposure that we have in the construction space is probably what is most beneficial. So over the years, we've built in a pretty extensive network of referral partners, whether it be builders or land developers. And also because of the amount of volume that we do purely focus on construction finance or home and land finance, we're aware of certain developers, like, I suppose, contract conditions. We're aware of the builder sales processes as well. So our business, we do about $90 million in lending every month, and about 70% of that is home and land finance. So we're very entrenched in that space, whereas the typical broker, maybe out of 10 applications, they might do one, whereas we'll do 7 out of 10. So once again, understanding when the land contract deposit is payable, when the builder's deposit is payable, when your contract's actually going to be issued. Every builder's got a different sort of process and time frame. So making sure we're mapping all that out for the customers. When you can actually get a formal approval. So, if you're buying an established property, you can probably get it right away. Whereas on a home and land application, you can get a pre-approval up front. But the formal approval may not be available until we get access to the land. So sometimes when you're dealing in a subdivision, you're buying off the plan. So you buy or you sign your contract today, but the land's not going to be available for you to start building for 6 months. So just understanding those timeframes and educating the clients on that. But then also using those timeframes to maybe improve the client situation. So can you save more? Can you reduce that? All these sort of things that we recommend and present to the customers.
Yeah, it's an important point.
When that's the case, then that.
Sorry, Daz. It's an important point and one that we find there's a little bit more complexity in our space because you don't just have a house sitting there that you can go and that's what it is and that's what you're going to get the loan for. I personally think, people are mad to go to one bank to get one product. They're only going to give you their options when you've got finance brokers across the board. You can choose to get flexibility, and it doesn't really matter if you're buying established. Going to a broker is still good, and buying a new home, going to a broker is still good. Why you would choose the other way, I just don't understand in this day and age. And it seems like brokers are much more, prominent now, and it becomes more accepted, which is great. So I think for clients, so I guess people listening, understanding that you're there to service them and find the right solution for their needs. So if that means that they need land that title's a little bit further away than now because they need a bit more money saved, then you can actually provide that solution and walk them through and educate them. And that's something that I think people need to be aware of. And that's why you need to go to a broker, because they will help you in that sense. Yeah.
Absolutely. Yeah.
What I was going to touch on, Colin, was obviously Mark, as that time frame as well. If you buy land that doesn't title for 12 months and you're able to help position that customer's situation a bit better financially, then you may actually end up even changing lenders, I assume, to a better loan that actually might be a better rate or a better set of services that are attached to that loan that's going to be a benefit to that customer in that, in the future, which is great.
Yeah, absolutely. So, once again, even if the clients, I always like to work on savings plans for the benefit of the customer. Ultimately, the more they save, the less they need to borrow. Cheaper things like mortgage insurance, and as you alluded to, interest rates are going to be as well. So, anything that we can do to improve the client's situation or position, it's obviously going to save them money in the long term. We always try to recommend. For sure.
So let's move to interest rates, being the topic that everyone's talking about. I'd love to hear a lot of your feedback on what people are asking you and what you're advising in terms of interest rates and what to expect and things, without having a crystal ball, of course. But maybe before you do that, just start with the basics. What are interest rates? For those who are really new to this, what are interest rates? How do they work? A little bit on RBA or inflation and things like that. Could you just give a really short snapshot for those people who are fresh to this?
Yeah, of course. People tend to get a little bit confused between home loan interest rates and the cash rate. So cash rate's obviously driven by the Reserve Bank of Australia. Cash rate as it stands today is 3.6%. It was, going back May last year, 0.1%, I believe. So it's obviously increased quite a lot in a short period of time. They tend to sort of move based on inflation. So I think the last time the figures were reported for inflation was 6.8%. The target cash rate at the moment is going to be about 2 to 3%. So they want the inflation rate to reduce. Lenders obviously don't lend at that rate. They'll obviously borrow money at their cost and also have a margin on that. So what we're seeing between a lot of different banks is the variable rates could be maybe low fives, upwards to about maybe 7%, depending on the bank, your customer profile, and how much deposit you have.
Right.
Yeah, and that's obviously what you'll make repayments on.
Yeah.
Okay. In terms of just the Reserve Bank, right? And I might be able to half answer this because I only learnt this in the last couple of days myself. But where's the Reserve Bank getting its money from, Mark? I guess and that's somewhat of a loaded question because I'm happy to jump in on that as well. But it's certainly an interesting scenario of the Reserve Bank is obviously lending money to banks, but where does it get its money from?
International borrowers, like bank bonds and all that sort of thing. So yeah. But once again, the Reserve Bank doesn't actually lend money. They're the ones that sort of set the target cash rate to sort of drive inflation. So if they're, let's say, banks can borrow money from all different sources, sometimes from international sort of funding as well. A lot of the funds can come from the US for a lot of banks. But the key driver for the Reserve Bank when they're sort of setting the cash rates is inflation. So obviously the higher the cash rate, the slower the inflation is going to grow. So that's typically what they try to do. We hadn't seen a cash rate increase for almost 10 years. And then we've had a whole series of them since May last year. So it's obviously spooked quite a lot of people because they haven't seen that in such a long time. And a lot of borrowers, this is the first time we've seen any type of increase. It's been a decade since we've seen it.
Amazing, isn't it? 10 years. Wow. Yeah. I know certainly some of the early loans I took out, and I'm not talking the big numbers that people spoke about in the 80s, but, I know our interest rates on our first home topped out over 10%. Yeah. So, it's interesting seeing where it's at and obviously borrowing a lot less money. That's probably the big difference. But, interesting times. How's your crystal ball looking, mate?
So if I look at the last 2 months, it's funny, you speak to 20 different economists, they've all got different answers. Obviously, inflation's like one of the main things that I'll look at. In the last 2 months, inflation's dropped by about 1%. So what the Reserve Bank is trying to achieve is working. Usually the lag indicator between when the rate goes up to when it affects the household budgets, it's usually about 4 to 5 months. So I'd say inflation is still due to reduce over the next coming months. Today is the Reserve Bank only met last week, or this week, sorry, I should say, and they've decided to keep the cash rate at 3.6%. A lot of economists are still predicting that it's due to go up, so I would say maybe another 1 or 2%.
Hopefully not 1 or 2%.
Two increases, I should say, and I would say 0.25. So maybe another 0.25 to 0.5% increase is probably where we're going to see it finish. And then we'll start to see a slowdown. A lot of economists are sort of tipping the cash rate the inflation rate's probably going to be around the 4% by the end of this year.
Cool.
2.8% away from that.
I just got back from the States and last week, and one thing I really noticed there, the inflation is very much like here, very, high inflation, prices are high on everything. It was quite, probably a bit more of a shock than I expected. But the one bit I was really surprised at is their wages growth that I don't think we've had here. So I think that's a real positive for us, is that the wages growth hasn't been anywhere near as high as the US, and that sets us in a better position to see our interest rates cap out sooner than theirs. Yeah. And hopefully, see the slide go the other way and come back a bit too. So Look, and also like you sort of look at the the history of the Reserve Bank, like where we are at the moment. It isn't high if you're looking at a 10-year average post the COVID environment. We're probably about 0.6, 0.7% above the 10-year average. But once again, people sort of comparing it to the market where it's only 0.1%. So, it is high in comparison to that period, but over the history of the Reserve Bank, it's not too bad. Yep. Yeah, for sure. Certainly keeps the challenges coming though, doesn't it, really, in that respect? And even for yourself, I'm sure you've had people who have qualified for loans and with that rising interest rate are now struggling to qualify or don't qualify anymore. Is that something you're seeing?
Yeah, absolutely. So good point. I suppose the net reduction on the average borrower since the rates started to go up is about 25%. So just working on round figures, if you're qualified for a loan of $1 million back in May, it's probably going to be about $750,000 today. Usually every time the Reserve Bank meets, if it goes up by about 0.25, the average borrower would be affected by about $12,500 to $15,000 reduction in borrowing capacity.
Yeah, interesting.
It's a big realization for people, isn't it? You know, Cole, I mean, people are coming and visiting the likes of ourselves and now they've got to, realign their expectations. I don't know how you're seeing that, Colin, and whether that's happening a bit with you guys, but certainly at my end, for sure, that's happening.
Yeah, I'd say we've always been in a position of explaining and educating people from perception down to reality when it comes to new homes. And that's perhaps because, there's a lot of confusion and complexity around it. And when we're talking just finance, I think we are getting those questions now. So it's good to have you here, Mark, to talk about. I would put all that into one bucket being buyer confidence. So I'd probably be keen just to hear a couple of comments from you around what are the concerns. Like if there's a client listening right now, an investor or a first home buyer, it doesn't really matter, but they're sitting there thinking, well, I've got a deposit. I'm not quite sure with the interest rates where my capacity's at. What are the greatest concerns you're hearing from customers? What are your answers to them in the current market? And why should they or shouldn't they be thinking about proceeding with new home construction right now?
Yeah. I suppose the main concern with buyers that we're speaking to today is borrowing capacity and also affordability. So affordability sort of translates to what the interest rates and repayments are going to be to get into the new home. In the market where the cash rate was low, more often than not, it was actually cheaper to buy a house compared to rent. Now it is slightly more, but a lot of things. One thing that a lot of people don't take into consideration is they're comparing a principal and interest repayment, which you're actually paying off your loan, compared to a rent repayment where you're just paying rent month by month. The benefit,
you got nothing for it at the end.
Yeah, the benefit is obviously you've got your capital growth when you do buy a property, but also your principal is actually reducing your loan balance each and every month, right? So, in my view, it's always going to be better to own your home as opposed to rent. So even if it is going to cost you slightly more, you've got the ownership and it is your property. Obviously, another thing that clients will sort of be concerned about is I suppose the economy and what's going to be happening with their jobs and all that sort of thing. So that's in my view, employment's still relatively strong. I don't think that's going to be something that's going to be too much of a concern in the immediate future. But
yeah, I agree.
They're the things that we're speaking to clients about lately.
Yeah. One more on that. Sorry, Daz. When clients are asking about their capacity and stuff, how are you future proofing their confidence in terms of that rate? Now we're in a position where it's still crystal ball stuff. We've had one pause and we're expecting one or two more, and then a lot of people are saying it might just calm down a little bit. So when you're talking to your clients, are you preempting or providing capacity based on what sort of rate, I suppose? You know what I mean, what I'm asking there?
Yeah, absolutely. So one thing I'll say is borrowing capacity can vary dramatically from one bank to another. So we did some modeling not too long ago, and then the highest and lowest bank for the exact same customer profile varied by about $170,000 in terms of loan amount, right?
Yeah, wow.
So that's one thing. So
that's almost bridging the gap of the difference that they've lost in borrowing capacity in the right circumstances, and that's if they'd qualify for that loan. But it's a big gap, isn't it?
Absolutely. Another thing that obviously, it affects borrowing capacity and a lot of people don't really know about is what we call an assessment rate, right? So you as a customer will be borrowing at, let's say it's 5% or 5.5%. When the bank assesses your affordability, they'll work on what we call an assessment rate being that buffer of 3%. So they assess your repayments on 8.5% if you're borrowing at 5.5. It's not to say you're paying that amount as a mortgage repayment, but what they're doing is they want to make sure that in the event of interest rate fluctuation, you can still afford that loan. So the banks are already allowing certain buffers, right? Another thing that we look at when we are talking to our customers is their debt profile as well. So do they have car loans? Do they have credit cards? Do they have any sort of debt that we can maybe close off or consolidate? A credit card, for instance, let's say you've got a $10,000 limit. A lot of clients tend to think, if I'm paying this off every month, it's not going to impact my borrowing capacity, but it does. The banks will normally expense 3.8% of that credit card limit as a repayment every month. So we know that's probably going to reduce your borrowing capacity by about $70,000 to maybe $80,000 approximately, depending on which bank. So just by cancelling that credit card, and obviously going to a different bank because of better borrowing capacity can improve that customer situation by maybe $200,000, $250,000 between the highest and the lowest bank. Yeah.
I think the other part around the interest rates, Mark, is as those interest rates hit their peak, then you're probably the opposite end of that is the market's probably hit its, or certainly got, it may have turned the bottom of the market too. A lot of people try and pick the bottom of the market. And I think that, that swing can happen pretty quick. We've seen a pause. There's a bit of buyer confidence in the established market right now. There's talk of property prices starting to turn the corner again. And everyone's trying to think they're the next genius and can pick the bottom of the market. But, it's difficult. And if interest rates continue to go up, bottom of the market might not be there yet. But if interest rates pause now and then go the other way, and there's some chance that could happen too, might see the market turn pretty quick. And, migration numbers are up. They're talking 650,000 people coming into the country over the next couple of years. There's plenty of drivers saying that the market's going to turn pretty quick, I think. So it's interesting to watch where all that plays out.
Yeah, my view has always been time in the market as opposed to timing the market, So I don't think that's right or wrong time as long as you've got a long-term strategy with property. And historically, they've always gone up, right, over a long period of time. So yes, if you're looking at a 6-month block, a 12-month block or whatever, the property prices can fluctuate. They can go up and down. But, if it's a long-term plan of yours, then in my view, if you're in a position to purchase today, I would say that would be the right time.
Yeah, great point.
Just going to ask the next one, moving on to, I guess, one question people consider. Some people just know they want to build new. No questions asked. That's what they want to do because they want a brand new house the way they want it, their colours, etc. But a lot of people are not sure. Obviously you can get an established home for a little bit cheaper, but you don't get the features of a new and vice versa. So when people ask you that question, building new, should I build new? Should I buy established? What's your answer to that question? And I guess you could blend in, we could talk about the government schemes and advantages and stuff like that as well. Yeah. Because you must get that question a lot, would you?
Almost every day.
Right.
Look, at the end of the day, it is personal preference. And I'm going to be a little bit biased in my response to this because, we do quite a lot of it. But for me, as a first home buyer, even a second or third home buyer, or as an investor as well, it's probably, I suppose, a little bit more affordable to get into the market when it comes to home and land for the fact that you are getting the government grants on a brand new build compared to something that's established. So that's $10,000 for a first home buyer that you're able to use as part of your deposit. Another thing is obviously stamp duty, right? So stamp duty, if you're a first home buyer, as long as the land value in Victoria is below $600,000, you're exempt from paying any stamp duty. Even if the contract value for land and building exceeds that $600,000 value, they only look at the land portion when it comes to what you pay in stamp duty, right? Also, let's say, for instance, if you buy what we call a one-part contract, being an established property or townhouse or whatever it is, you would normally pay stamp duty on the entire thing if it's a built-up property, right? As a first-home buyer, if that contract value exceeds $600,000, you're going to have to pay stamp duty, right? So that's another cost. Why a lot of investors, I would say, would favour home and land compared to an established property again is the stamp duty component. So whilst you're not exempt, you would only pay stamp duty on the land component as opposed to the land and building. So even if you buy something that's off the plan, if it's a one-part contract as an investor, even if the construction hasn't commenced yet, you'd have to pay full stamp duty on the entire lot. Whereas land and building, once again, it's a lot cheaper to get in.
Certainly, if you're an investor buying new, you're also getting that greater level of depreciation as well on a new home, which is another one of the great savings for people in that space.
Absolutely. Yeah.
Good. Valuations, mate, in the market. Are you seeing valuation issues? It's something that does come around, as these sort of markets come, about.
Look, we're not too affected right now, but I do think that it will start to come shortly. Usually, what will impact valuations, in my view, are rebates. So obviously, when sales start to dry up, developers obviously look at ways of attracting new customers. And historically, what they've been doing is they normally start by reducing the amount of deposit you're needing to actually sign a contract. So, in a busy market, they can ask upwards to about 10%. Now we're seeing some developers ask for about $5,000 or $10,000, right?
Yep.
The second part of that would be offering rebates. So let's say you've got a block of land that you're purchasing for $400,000. Developer says, if you sign this contract and you settle by a certain period or date, we'll give you a $20,000 discount. So, when you're signing that contract today, that block's only going to cost me $380,000 net of the rebate. That could actually affect clients that might have bought a block of land maybe a month ago, 2 months ago, 3 months ago that didn't have that rebate attached. So they're the things that can affect valuations. And obviously, another thing is lack of comparable sales. So the type of property that you're looking to build within a certain area, are there many sales in that area to support the data or the sales price for what you purchased for?
Yeah.
Internally, we do have a process where we always like to order valuations up front because, they can sometimes be a variable, either going higher or lower than the contract price. More often than not, it comes in right on. But we do have the ability to order valuations of different institutions, with different valuation firms, and it can vary massively between one firm and another. We've had instances where on the exact same house or land and building, the valuation varied for about $200,000. So my view is the valuation is a matter of the valuer's opinion. Yes, they come up with comparable sales and everything else, but, on the same type of property, one valuer's either got it very, very wrong and the other one, either coming on market. So, we sort of take it with a grain of salt. We will obviously try to work always a little bit harder on trying to find the right solution for the customers if the valuation was to come in low.
Yeah, sure. Good. The take up on the government schemes at the moment, mate, how are you finding that? Are you guys coming across many? I mean, the one that I'm a bit of a fan of myself is the first home buyers deposit scheme. Yep. Maybe a bit of an explanation on that. And, and obviously there's plenty of spots available and people may not be aware of it and are missing out right now on an opportunity to get into the market.
Yeah.
Right now.
So that particular scheme is probably more of a long-term strategy to get into the market. It's not something that you can, have access to immediately. So I suppose just to give you a high-level overview, it's, you're using your superannuation or salary packaging your salary to make superannuation contributions, which will then be used for a deposit. So I think the time frame for that is about 2 to 3 years from memory. It's not something that we do a lot of, to be honest with you, in our space, purely because of, we don't really talk to customers today that want to buy in three years. It's more 6 to 12 months. And then for that, what we sort of will talk about is other schemes. So the new home guarantee, for instance, I think is something that's really, really attractive for first home buyers. Just to give you an overview on what it is, it allows you to buy a property with a 5% deposit and avoid the cost of mortgage insurance, right? So mortgage insurance would always be applicable when you're borrowing anything above 80% of the property's value. But if you're a first home buyer, an Australian citizen, it is income assessed as well. So it's $125,000 for a single applicant or $200,000 as a couple. And the price cap across most metro pockets and regional cities is about $850,000. So as long as you're within these parameters, you can avoid mortgage insurance. But one of the other benefits that a lot of people aren't aware of is the bank will actually price your interest rate on an 80% loan. So that could actually save you quite a lot of money as well in terms of repayments. We do quite a lot in that space, and it's something that I think is a really good initiative by the government.
Yeah, and a great chance for first home buyers to get into the market using something like that where they may have felt they didn't have that opportunity.
Yeah, absolutely.
Yeah, it's great. Where can people, obviously talking to a broker, you're tailored to provide the right solution for each client. and that includes these schemes and these really, I guess, helpful incentives for people who do qualify. Where's the best place to get that information? Do you have some stuff on your website? Should they just be giving you a call and booking a time? How does the process work if someone does want to talk to a broker or to you guys specifically as well?
Yeah, we've got quite a lot of content on our website. Also, some other places that you could go to do a bit of research would be the State Revenue Office website as well. There's quite a lot of information there about the government grants and government grants and schemes. But once again, it can be a little bit confusing. I would say the best thing to do would be to reach out to a broker and just see what schemes you're eligible for, because they can obviously vary depending on your circumstances as well. Just as an example, we spoke about the new home guarantee. To get a first homeowner grant, you only need to be a permanent resident, but the new home guarantee, you need to be an Australian citizen. So they're the variances across those two schemes. And obviously one's income assessed, the other one isn't. So you just want to make sure that you're sort of tailoring the right schemes based on your circumstances.
Yeah,
for sure. It's good.
Yeah, good. Pretty much went through most of our points there, haven't we, Daz?
Yeah, we've covered them off nicely. I did want to ask one more. Sorry, Mark. Just thinking about it. Another one that I really appreciate when brokers get involved, and I think they're really good in that space. And mate, you guys are the best at it. But things like getting your parents involved. You're a young first home buyer, and you're just not quite there, but you can obviously get your parents involved in trying to get your finance through. Maybe talk through some of that as well. And because again, I think that's a missing link in the market right now, is the first home buyers in the market missing that opportunity to buy and maybe not finding the way. So maybe talk a bit about how your parents can get involved in helping you out, other than just giving you a cash lump sum of money, which would be really nice.
That'd be nice, but not always available. Guarantor lending is, I think, what you're alluding to.
Absolutely.
So what that is let's say you're looking to buy a property. Mum and dad have a property of their own, and there's a certain amount of equity in that property, right? They are able to put up a portion of their equity or their house's security to then be leveraged off to purchase your property. So just to give you some sort of high-level figures, let's assume you're buying a property for $1 million, right? Banks do what we call a limited guarantee, and what we mean by limited is they will guarantee any amount that exceeds 80% of that property's value. So $1 million, if you work on 80% of that, that's $800,000. So if you're borrowing, let's say, $1 million against that property, they'd have to guarantee $200,000 of that against their own home. So you want to make sure that there's enough equity in order for you to do that. The benefits of a guarantor would be, once again, not having to pay mortgage insurance. Gives you access to a little bit more in terms of the lenders as well, for to sort of minimize things like repayments. One thing a lot of people aren't aware of is if you're applying for a loan at, let's say, the Commonwealth Bank and mum and dad at Westpac, it doesn't mean that they need to actually change their banks. The first bank can actually take what we call a second mortgage against their property. So it doesn't sort of impact their current home loan, but obviously they would be liable for that guaranteed portion. We always sort of work on the basis that, in the next maybe 3, 4, 5, 6 years or however long it takes, you might be in a position to actually release mum and dad from the guarantor. So it's not like a permanent thing. We'll obviously review it just to determine if there's enough equity, and then at that point we can potentially release mum and dad from being a guarantor. But it's a really good tool to get people in the market. I suppose the benefits would also be you don't necessarily need to buy for owner-occupied purposes. If let's say you're a first home buyer, but you want to buy an investment property, obviously you wouldn't be eligible for any stamp duty exemption with the first homeowner grant, so your deposits are also reducing because of that fact. But the guarantor option would obviously offset that, because you can borrow up to 100% of the property's value, plus even maybe some of the costs as well. So maybe some banks will go as high as 105%.
Yeah, right. Yeah, good. Yeah, I think as a parent, you want to help your kids out where you can. So if, you haven't got the cash to do it, it could be a good way to really get involved and help them get on the property ladder. So
yeah, absolutely. It's something that we're doing pretty actively in the past. I think with the new home guarantee, some of that I suppose, activities being diverted to the new home guarantee. But it's definitely something that's, that we still promote with maybe the investor type first home buyer.
Yeah, cool.
Yeah.
Great, man. Awesome.
Well,
Really good.
We're just nudging the 40-minute mark, so I think we will call it a day there. I want to say, firstly, thank you to you, Mark, for joining us and sharing your insights. Obviously, you've got so much experience. And for anyone who wants to reach out to Mark, we will provide the details. But, Mark, what's your website for people to head to?
Yeah, it's www.mortgagedomayne.com.au. Domain is spelled DOMAYNE.com.au. Yeah.
Awesome. Thank you. Last thing, I think, what are a couple of tips you have for new home buyers or investors, your choice? What would be 1 or 2 or 3 top tips for them to take away from this episode?
Look, I would say look at what you can afford, not what you can borrow. Borrowing capacity is never going to be aligned to people's individual circumstances. When the banks assess your current situation, it's pretty standardized. So you might have X amount of living expenses, which could be above what the bank is allowing for. So work on repayments, I suppose, and what you're sort of comfortable as a maximum. Don't always be loyal to your bank because there could be some better options out there. For instance, so Commonwealth Bank they just recently made an announcement for any borrowers wanting to borrow up to 95%. They've actually increased the rates, whereas some of the banks will actually reduce the rate compared to what the Commonwealth Bank's able to offer. I would say, do your research, but I would say speak to a trusted and educated broker that's had a bit of experience because, they're the ones that got all the knowledge and they can sort of, guide you in the right direction because jumping online, the information can be a little bit confusing and overwhelming. Just speak to someone that's a little bit experienced in that space.
Yeah. Yeah, well said. I like the, look at what you can afford, not what you can borrow. Nice tip. Again, so thank you, Mark. Thanks, Daz. I think we did pretty well there. We've got some good insights and some fantastic education for people listening, no matter really what step they're at. So I want to say thank you to the listeners as well. For anyone who's up for it, leave us a 5-star review on the platform you're listening to. That would be really helpful. And please share. I think, Darren, you referred to the only cost of listening is to share the podcast. Is that right?
Absolutely.
Is that your term?
Absolutely, mate.
So it's a free podcast, but that's the cost.
Fee, mate. If the fee is if you enjoyed the show, share it with someone else. So,
that'd be really good. So we're obviously aiming to provide value and really keep it independent for you. And if you have any other feedback or topics or things that you want to share with us, you can just head to the Home Building Hub. Actually, it is homebuildinghub.com.au. There's a question thing there. You can just contact us and go from there. So thanks again, guys. Appreciate your time. And until next time, see you later.
Thanks, Mark. Thanks, Colin.